Hi, everyone. Thanks so much for being here. I'm Aislinn Keely. I'm a reporter at The Block, and I mainly cover policy and regulation. And that's basically what we're here to talk about today. We have a great panel of experts here to talk about their experience in navigating regulations at different firms and building compliance systems amid an uncertain regulatory climate that can be, firmer in some areas rather than others. So thanks so much for being here, everybody. And yeah, I figured we would start off by each person sort of giving a sense of what their expertise is and also a bit of their background. So Rachel, let's start with you. Can you give us a sense of, the regulations you're most attuned to and what you've worked with before, and perhaps your experience in building compliance systems?
Sure. Nice to see all of you. So I'm the Chief Legal Officer of Iex. Iex is a national securities exchange that builds technology to move finance forward and innovates to provide for investor protections. And we are currently joining forces with FTX and very glad to be joined by Ryne today on this panel. And we are working together to help shape market structure for digital assets. And that is the project that we've publicly announced and we're working together on between the two companies of FTX and IEX.
Great. And Ryne, let's go to you then.
Okay, I'm unmuted. Sure. Hello, I'm Ryne Miller. I'm the general counsel of FTX US. So we've got a few businesses inside of FTX US. We run a cryptocurrency spot exchange, so that competes with like Coinbase, Kraken, Gemini, all the US crypto spot exchanges. We have a sister company, FTX.com, which is outside of the US and services international customers with both a spot venue and various derivatives products. In the US, we have a derivatives exchange that has a limited product set today, and we're working to expand that. Some folks have followed that story, making progress there. We have a stocks business, so a broker dealer that just offers retail stock execution, traditional equities, and working on a lot of other exciting stuff. As Rachel mentioned, some digital asset securities work streams. We've got an NFT marketplace that's interesting and we hope eventually has a lot of users, but yeah, a lot of moving pieces.
Great. And Zai, can you give us a sense of your background and what you're most comfortable navigating?
Sure. Hi, I'm Massari. I am the CLO of Lightspark as of 3 weeks ago. I joined Lightspark from Davis Polk, a law firm, where I was a partner in the financial institutions group and specialized in financial regulation of all sorts. I did a lot of work on stablecoins, so happy to chat about that today, as well as various aspects of financial regulation as it's relevant to crypto activities.
Great. And Matt, let's go to you.
Good morning or afternoon if you're on the East Coast. My name is Matt Lisle. I'm currently a member of the legal department at Galaxy Digital, which is a full-service institutional crypto investment platform offering a great deal of solutions to institutional investors. Prior to that, I was general counsel of a startup called Drawbridge Lending, which was a collateralized lending platform to institutional borrowers. And then before that, I am a derivatives lawyer by training. So I've worked for exchanges and brokers, and also started my career at the CFTC as a staff lawyer. And then the other thing that I do, I wear kind of a different hat on a volunteer basis. I've been heavily involved in an initiative to start up an SRO in the digital asset space. It's called Global DCA. Heavily involved in starting that up from a governance standpoint, as well as I served as their first chairman. So very sort of ensconced in the world of regulation and the uncertainty, but my knowledge is an inch deep and a mile wide. Let's put it that way.
Great. And Mike, last but not least, could you give us a sense of what you've really been building and where that expertise has led you?
Thanks. Good to see everyone. Mike Casglioni, Director of Regulatory Affairs for Digital Assets at Eventus. Eventus is a software company. We build technology to help financial institutions do compliance, specializing in trade surveillance and transaction monitoring. We're multi-asset class, and our crypto side has been growing very quickly. I came to Eventus after 15 years working national security issues in the U.S. government, including with the CIA. And our company thesis is that as crypto adoption expands, institutions and retail, and as Web3 businesses allow for a proliferation of digital ownership, there'll be more trading, and therefore being able to detect and therefore prevent price manipulation in markets is essential for really the trust and safety. It's great that so many companies are being proactive in kind of thinking about this topic beforehand.
Absolutely. And it's a really broad topic. So we're going to try and get as wide and as deep as we can on each part that we can, but obviously it's a very large umbrella. So to start, and I know it's a broad question to start with, maybe Matt, you've had your fingers in a lot of pies, and so I'd love to know, what tends to come up the most time and again. Obviously firms are beholden to different regulators depending on what services they're offering. But what are the nuts and bolts of a compliance process that you see continuously coming up?
Okay, well, let me try and answer that question. The first day that I started in the crypto space, the first thing that you are confronted with is the issue around AML KYC, and that is identifying your counterparty. In this world, the technology is unique, and it is also in many cases designed to be anonymous. And it's global. So you are confronted with the fact that you need to, from a regulatory standpoint, try and identify as best you can who that counterparty is. And so in most cases, you end up relying on the types of best practices and processes that you can draw upon from the traditional financial world. So that's first and foremost. The second thing that I confronted is the issue of custody of bits and bytes, and how that applies in the U.S. regulatory sphere under the Uniform Commercial Code and so forth. The third thing you run across is from a trading aspect, can I trade that product legally? And you have a full patchwork or panoply of rules and regulations that you have to that you're confronted with, SEC rules, CFTC rules, Fed rules to an extent. So you've got that, and then you've got licensing issues. And licensing, do I need to have a license to do this particular business? In my case, at my startup firm, it was in the lending space, and lending rules are typically at a state level. So you have to get 50 state licenses, or at least look at, regimes, lending licensing regimes at 50 states plus territories. So that can be a very expensive and time-consuming process. I could go on and on probably and list some various things, but I can tell you, and I think everybody on this call or webinar will agree that most everything that you confront, there aren't any hard and fast answers to it.
Absolutely. And so it seems like we have two sort of branches here where we have regulations that are written that we can harken back to, that when you're starting a project, you can look at and say, these are the things I have to do. And then there are these gray areas. And often those gray areas are sort of nailed down by enforcement. We see what people have been allowed to do and what they have not been allowed to do. And so when we look at the enforcement landscape right now from a variety of different agencies, what is that telling us? What are some key areas that are perhaps being shored up by enforcement right now that were a little more gray before? Rachel, do you have something to say on that?
Sure. I think we probably could all agree that regulation by enforcement is not necessarily the appropriate path. And what we do need is regulatory clarity. And I think that comes down to what is the regulatory clarity. And I believe we can get a little bit more granular to achieve that clarity instead of just saying we need regulatory clarity. So I'm going to provide sort of my takeaway on maybe what sort of that regulatory clarity could be. So one, takeaway for me when I saw the BlockFi settlement that I thought was really interesting was the SEC characterized the BlockFi BIAs as notes or debt, which they applied the Reeves test. And what you can learn from that is that, how things are characterized, labels matter. Because in other sort of enforcement actions, the SEC categorized tokens as investment contracts under the Howey test. In other words, they didn't characterize them as equity or debt. And that makes a huge difference on the law and can actually set the regulatory framework moving forward. Because under the law, there are stocks, which are equities, which are essentially an ownership interest in a company. There are notes, which is debt, which we saw was in the BlockFi settlement. And then there are investment contracts. And that is a catch-all category for novel instruments that fall under the Howey test. And why this is all important, and the takeaway is that when you look at the securities laws, the disclosures that currently are out there are often difficult to complete. And people say, why don't we need regulatory clarity? And what they're saying is we need everyone to recognize that these are not necessarily equity or debt in many circumstances. And therefore, what we need is a separate asset class. And once you define it as what it is, an investment contract and a separate asset class, and I believe Congress and the SEC has already, in effect, defined it as an investment contract in certain circumstances for only certain tokens, then there's no longer this conflation between equity, debt, and investment contracts. And then the regulatory clarity can come in on this particular asset class. And lastly, what I mean is essentially disclosures can be tailored for that particular asset classes. Custody can be tailored for that particular asset class. All of the regulatory clarity can be made by recognizing that it is a separate asset class.
Rachel, if I could jump in, I so agree with your comments. All of that is so astute. I would even take it a step further, to be honest, right? Which is, I think all of us in legal practices involving crypto have spent the last, 8 years trying to draw those distinctions between different types of crypto assets. Is this an investment contract? Is it not an investment contract? Is it more like money? Like, what makes it more like an investment contract and why? Despite claims to the contrary, it is not at all clear. And I would say that neither the Reeves test nor the Howey test provide clear answers, repeatable, clear tests as to when tokens are securities or are not securities, including, frankly, by just observing the fact that even the SEC thinks that status can change over time. And that's not a regulatory environment in which businesses can meaningfully operate. And I think really the way to think about the policy goals of this is if you have tokens trading on order book platforms with retail consumers, there should be consumer protections. Those don't need to be cramming those activities into a securities regime or into a derivatives regime. It can be something separate, but should provide the same kinds of protections against insider and outsider information and protection of consumer assets the existing regimes provide. And I think that perhaps a little Pollyannish would be actually the best result. Treat digital assets similarly to securities and listed derivatives, but don't require everyone to go through this sort of terrible and unuseful exercise of trying to classify assets that don't fit well into existing regimes into those regimes.
Yeah,
I would add to those really, I'll second that astute comments. First of all, Zai, there's not enough Pollyannas in this space, so please continue to joust at windmills. I think that, in my role at the Global DCA, we've gotten heavily involved in the discussions that are happening on Capitol Hill. We have commented on a number of pieces of legislation, including Senator Toomey asked for comments as to, what types of regulations should be there. That was last fall. And then most recently, a couple of members of the House and the House Ag Committee put out a bill called the Digital Commodity Exchange Act. And in both of those comments and subsequent discussions that we had, we centered on the importance of taxonomy in this space. Taxonomy is going to be the fundamental issue, I think, in order to solve some of these regulatory conundrums that we confront every day. And in our TUMI response, you know, and it's not public, unfortunately, it's embargoed, but one of the things we focused on is a survey of taxonomy around the world. And we centered on the Swiss FINMA, which is their version of the SEC, has a very simple taxonomy, and they divide up digital protocols, digital assets into 3 different classes. And they call them as they are. There's security tokens, there are utility tokens, and payment tokens. And so you can see how if you simplify this area and then provide some specific definitions, and then also the FINMA is very open to questions from the industry as to, you know, whether or not a particular protocol or token fits within a particular taxonomy. And they're fairly responsive to those requests. Now, again, I'll go back to being Pollyannish. You know, that is not something that's probably practical within much more complex regulatory structure here in the United States, where you have regulatory turf wars that are very real and need to be navigated. But at the end of the day, my point is that taxonomy, and I'll just echo Rachel's comments, taxonomy is very, very important. Are you going to call something a commodity? Are you going to call something a security? Are you going to call something a payment token? And I think that then indicates which regulatory regime will apply.
Absolutely. So in lieu of that clear taxonomy at the moment, you know, how does a platform operate? Ryne, FTX has a lot of different types of trading activity. How do you build a compliance program when you don't have that clear taxonomy?
Good question. So there's a lot of different aspects of a compliance program. There's sort of regulatory compliance, which I think is what the first part of this discussion covered, which is which products are you listing? Are you licensed to list those products? Are the users that you're permitting to trade those products allowed to trade those products under whatever regulatory regime applies? In the US, we've taken a very simple and conservative approach. For anything that we've listed, we've gotten to a conclusion ourselves that we are not a securities exchange. Like Rachel mentioned that we're doing some interesting projects with them. But today, FTX US is not a securities exchange, does not list coins that are securities. And so we go through a review with outside counsel. We have an internal policy, and we get to a conclusion, not just on the securities laws, but importantly on the securities laws, that we're not listing something that we think risks being a security. The other 2 things that we do before we list a new product in the United States is we try to get comfortable, and we do get comfortable, that we're not going to implicate the commodities laws or financial crimes laws with those products. Commodities laws is somewhat straightforward in that the CFTC, that's the U.S. commodities regulator, of course, they've got jurisdiction on fraud and manipulation for crypto spot markets. They don't have a registration hook. They don't have an ability to require intermediaries to do reporting or be registered, but they do have the ability to look at transactions for fraud and manipulation. And so we do some review with outside consultants and ourselves of a token and a project and the token ecosystem around it. And we use our surveillance vendors as well, folks like Eventus and others, to ensure that we're not listing tokens that everyone thinks are just manipulated all the time, and everyone thinks there's a bunch of disruptive trading or inappropriate trading. So that's the commodities law silo of the regulatory analysis on the product suite. And then there's the financial crimes silo, which is a big one. That's both around users and on products. With products, we're very slow to list things that have a reputation around being used to do financial crimes or to support financial crimes. In parallel with that, we do a full KYC review of our users. That's collecting a ton of information on the front end, running it through different vendors. But at the end of the day, it's our risk-weighted program for how do we get comfortable that a particular user is not engaging in money laundering or coming from a prohibited jurisdiction or otherwise an inappropriate user based on our risk-weighted approach to who we want on the platform. But you don't just get to do that at the beginning. It's very clear. So we're registered with FinCEN under the Department of the Treasury as a money services business. There's ongoing obligations too. So checking updated sanctions lists, checking updated jurisdictional blocks that need to be put into place. You saw this in real time with the Russia-Ukraine conflict and the additional sanctions that were put on different jurisdictions. We basically have to go through users at that point and refresh and update. And that's what happens. So there's a lot to a compliance program. It takes a ton of work, and that's where we spend most of our time.
Absolutely. And so you mentioned a lot of different things there, and we'll jump in on a lot of them. But I want to start with sanctions, just because it is, sort of an issue of the moment. So given current geopolitical affairs and that the White House has been more concerned with crypto compliance for sanctions, you mentioned a very manual process of making sure that you're complying, of refreshing and making sure those entities are blocked. Is that usually the process, or what types of ways are firms making sure that they're complying with those blocked entities?
Yeah, so a few reactions. First, I mean, sanctions is not a new thing for crypto companies. It's been very clear since, I'll call it, 2011, 2012, when you first started to build out, communities around interacting on these products, that the sanctions laws applied. Some of the first U.S. enforcement activity was around sanctions, AML type issues. And so that's been a focus for us the whole time of the business, not just recently with Russia and the White House interest. Obviously, that encourages you to stay focused on it, which we've been doing. How do you actually do it? With dollars and users, it's a somewhat traditional path. You get names, you get addresses, you get email addresses, phone numbers, and with dollars, you see the banks they're coming from. You can learn the identity of the owners of those bank accounts, and so it's somewhat of the same traditional path to sanctions compliance as you would do with a traditional financial product. The extra layer we have in this industry is that crypto can come in, so crypto assets, from wallets that aren't necessarily sitting somewhere else. That can be an unhosted wallet. And you're not going to have KYC or user owner identification of that wallet. There are a lot of tools, and there's a ton of great vendors out there that are building and refining these tools. But you're able to, one, we actually have wallets that are blacklisted by different governmental authorities, including in the US, and it's very easy to identify those wallets. If an asset comes in from there, you isolate it, and that's blocked. Those assets aren't able to be used. But you're also able to get risk-weighted scores or information profiles of different wallets. Are they interacting with blacklisted wallets? And based on whatever the scale is, are they likely to have assets that should be curtained off or not released into the platform? So that's roughly what our approach is, and how we navigate sanctions. It's a very ongoing and dynamic process. You don't do it once. You do it all the time. It's basically a program. It's just like trade surveillance, but it's sanctions surveillance.
Yeah, to add what Ryne has said, I just want to echo the importance of continued public-private partnerships. So the Department of Treasury has issued guidance on how to do AML and sanctions prevention or sanctions compliance in the crypto space, and it includes executive level buy-in, it includes risk assessments, it includes documentation and alerts to authorities if you find something. And like the overarching theme that we're seeing in regulators in the US and globally is that they are kind of taking the old playbook and applying it to crypto, right? Watching the same behaviors. So just this week, the FBI indicted a former employee of OpenSeas, an NFT exchange, for insider trading. And the FBI said this is an age-old scheme, right? So there are patterns of behaviors that we've seen in other asset classes that are happening in crypto. This is an example of insider trading. So there are things that you can watch for, and that's one of the things that we do at Eventus is build technology, learning from the manipulative and fraudulent behaviors in other asset classes and applying it to the crypto space.
Absolutely. And so one of the things I was thinking about as you both were speaking is that there are some places where there's a clear understanding where we've received directives, you must comply with sanctions, you must block these entities. And then some firms have sort of said, okay, well, we're going to go the extra mile. we're going to make sure we're stamping out activity, bad activity that we know has happened in traditional financial markets, and we're going to look out for it in crypto markets. But they haven't necessarily been directed to do that by a regulator. It's not necessarily clear that that's a requirement. How do firms navigate that? And how do you decide, where it's worth going the extra mile and where to really cut back and stick with the letter of the law?
I guess I could.
I could take a stab at that one. So we are a registered commodity pool operator and a commodity trading advisor. Those types of entities are not actually directly required to do AML KYC. But we chose to, put in place a very traditional AML KYC policy and process, and we did onboard our clients with respect to that process. So we then got audited, going to say about a year ago, by the National Futures Association. And it was very interesting because I thought, did a very good job in demonstrating that although we were in sort of this Wild West space, that we were endeavoring to do what we thought was the appropriate approach to regulation. And then a second sort of line of thought is, I'll go again back to global DCA. The model there is to try and develop good practices, best practices, and standards of conduct for members to voluntarily comply with. And in doing so, demonstrating to regulatory and public stakeholders that we take seriously the fact that you need to be able to establish the fact that you are a good actor and a good operator, and you do not do business with bad actors or bad operators. And so I think that you can go a long way to proving to regulatory stakeholders as well as the public that if you adopt on your own voluntarily standards and processes, that you can actually demonstrate, and that will go a long way toward preventative measures against regulatory enforcement and regulation by regulatory enforcement.
I will second what Matt said, and I could say from our perspective, we are looking to build a trading platform that's reliable, that's secure, and that provides transparency. So putting aside following the letters of the law and the regulatory compliance, it's also important that we have the trust in the market on our platform. And from us, we look at this as, how can we put investors first? How can we, avoid have anti-money laundering policies, have transaction monitoring, have the appropriate technology for trade surveillance, as Mike brought up. And this does require tailoring, that's for sure, because the current existing framework, let's say for like equities, is designed for a different asset class with a different technological underpinning. So it requires us to tailor and create a framework. But ultimately, that framework is focused on bringing in some of the fundamental principles that we currently see in the market into the digital assets. So we're approaching this as we look at what's currently, on the National Securities Exchange, and we say to ourselves, is this bringing investors protections? How can we incorporate it into this new model? Because ultimately, when you have a platform that is reliable, secure, and provides transparency, that is going to lead to the growth of the market. And most importantly, there's a lot of institutional investors that are sitting on the sidelines right now. And if we want to bring those institutional investors onto a market, they mandate that your platform is reliable, secure, and provides transparency. And so it's not a matter necessarily of following regulations and what the regulations is. It's a matter of getting it right and making sure that investors are protected so that we do have an efficient marketplace.
Yeah, I agree with Rachel, and those are the stakes. This is how we grow the pie, grow the market. One more thing to add is, government regulators, law enforcement, they can be patient. I was in government for 15 years. It's just a different time horizon. So when you think about compliance, you certainly should think about what's the current thing, and that's AML sanctions, but also what might be happening now that will be enforced 3 to 5 years from now. And that might include, price manipulation, trade surveillance, custody issues, and proper cybersecurity. So it's having that longer term viewpoint and seeing what has been disallowed in other asset classes, applying it to your business now, and projecting forward.
I'll just add another thing too. There's a separate dynamic that I think we need to be aware of or focus on. And that's the fact that this technology is moving at such a rapid pace, a rapid pace of development as well as uptake, and certainly that is going to outpace regulators and legislators. So I think you can count on that as something that is a dynamic that you're going to have to deal with. And the best way to do that, again, is applying best practices. Applying the very basic standards of doing business and positioning yourself as a good actor. Because, again, you're going to sit there and go, I don't know what the rules are, as you do today. It's going to happen tomorrow. Well, the best way to address that is to be proactive and get ahead of it.
That makes a lot of sense. And I like this idea of thinking about what's happening today and how that will affect the regulations of tomorrow. So I want to talk a little bit about what's happening today. And the first thing that comes to mind is the UST Luna fallout, and what that might tell us about what could come in the future. Is there anybody who wants to hop in on, how that might be shaping the regulatory conversation at the moment?
All right, I'll hop on that one. I think the lesson that can be learned through this is labels matter, and I know Matt was talking about taxonomies, and in this particular one, I think it does highlight that labels matter and transparency matters. So arguably, more disclosures about the token and what was happening with the Anchor protocol could have diverted losses. And so in terms of labels, you can probably sense a theme here that I think labels matter. But to break it down, a Bitcoin is a coin and it can call itself that. A coin backed by fiat with real assets and are regulated is a stable coin. You could probably suggest that it's stable if it's backed by real assets. A digital asset not regulated based on an algorithm may not be a stable coin. It's probably a riskier coin that requires more disclosures. A digital reflection of equity is stock. It's a digital share. A blockchain interest of a network on a token, and a token that might be registered in the future is a token. And I hope the industry figures out the importance of labeling, as conflating everything together essentially can help, weak projects piggyback off of good projects in the market. It can cause confusion. It could hurt investors, and it ultimately can stymie growth based on, inappropriate labels. And so I think a lot of this from the terror gives us learning lessons of, would disclosures and more transparency have led to a better outcome? And would labeling it as an algorithm-backed coin would have helped? And honestly, I think that education is really important, because even today, what frustrates me is that some people use the fact that it was called a stable coin, to suggest that all stable coins are similar, and they're not. And so I think that labeling really comes down to making sure that the instrument that you're referring to is transparent, is disclosed, and is labeled appropriately.
Yeah, I agree with you, Rachel, wholeheartedly. Let me add that, first of all, Terra, yikes. This is going to spur Congress and essentially the people that don't believe in the digital asset space to act. And your fear, your concern is that there's an overreaction to this. Yes, it was a bad thing. Yes, there was a lot of money that was lost. Yes, mostly retail investors suffered. So those are all bad things, and we have to be cognizant of that. But if you put a graph together that shows the overall performance of stablecoins, that are asset backed. You'll see a straight line in their performance. They performed as advertised. They're pegged to the dollar. They stayed there. And in terms of how do you address that from a regulatory standpoint, you'd hope to see like there's more a hands-off approach. You'd want to see support for these technologies. But at the same token, you definitely want to see some disclosure, and you definitely want to start clearing up the titles or the names that you place on these assets, so that people can understand what they are and what the risks are. So our hope is that there isn't an overreaction, but it's a very real possibility. Personally, I'm not a fan of applying full-blown banking regulation on top of stable coins, making these things have to buy into the FDIC system of insurance and so forth. These are somewhat outdated concepts, and I think we can do better going forward in terms of how to treat these.
Matt, maybe I'll jump in on the back of your observations about stablecoins. I fully agree. I mean, I think stablecoins are their own category of crypto. And I think regulators and policymakers have sort of recognized that they need to be regulated as the money instruments. Oops.
I think we may have lost Saeed, but I definitely want to hear, so we're going to come back to her when she's back. But at the moment, I do want to look at the questions tab just briefly, because I saw, Ryne, you answered a great question in our questions tab, which was, how does the group think about working with regulators ahead of time versus determining best practices internally and launching products or services? And maybe we can actually apply this question to this topic at hand. How do you think about working proactively with regulators in a moment like this?
Yes. So this might have been where Zahi was going, but stablecoin regulation is a good area where everyone's got an idea, like a reasonable, practical idea on how to do something regulatory wise with them that's better than what we have now, which is essentially nothing. Maybe some common law disclosures. And the question that had been posted was, do you just go internally, do your analysis and launch a product, or do you go and interact with regulators first and try to get some level of approval before you go out and launch something? I think principles-based regulators who are willing to have those conversations and get to like a reasonable structure and not tell you that you've got uncertainty going into launch would be a great thing. It's not the current structure in the US for a lot of good reasons and a lot of reasons that we could talk about, but regulators are really not incentivized to go out on the limb for your innovative product, your new program that doesn't look like what they've traditionally studied, what they've got 30 years of expertise in. And so it's a combination of both. Do you go and interact with regulators if you're going to be a repeat player in these markets? If your company wants to exist for more than 12 months, absolutely. You need to identify your primary regulators. You need to be in there often, telling them what you're doing, getting their questions on the industry, being a resource for them. That's what we do at FTX. That's what all of our peers do. We want to build and maintain repeat player, long-term relationships with regulators. At the same time, we don't expect them to, and they've not offered to, give us pre-review, a pre-approval of something on either a hypothetical or a non-live basis. It's not what they're structured to do. And they'll say, you go get counsel, you hire all the expensive lawyers. It used to be Zaid, but she left the law firm. It's very sad now. And you go come to a conclusion and launch it. And you know what our enforcement process looks like. And so you don't want that to happen. You know what the boundaries typically are there. In crypto, they started with real frauds, real deception, real manipulation. And now they're trending more towards, enforcement around maybe more prescriptive type rulemakings. But regulators are a great resource to maintain relationships with and post them on what you're doing. I don't think it's fair to expect them to pre-approve or stamp on something new or innovative. They're going to tell you to get your counsel, design it reasonably, and good luck. And that's really their job.
Absolutely. And Zai, I want to go back to you since we lost you for a moment. I'm so sorry.
That was so perfect. I think I was talking about stablecoin regulation. And I was agreeing with Matt that I think there is movement among financial regulators, in particular banking regulators, Treasury, and then also in Congress to try to regulate stablecoins, what I call true stablecoins, or the President's Working Group is calling payment stablecoins, which are those issued by companies backed by short-term, high-quality liquid assets. I think the view is that those have scaled quite quickly and need to be regulated. Maybe Terra and Luna sort of add focus to those efforts. We are in a little bit of a weird time, I think, though, where it seems like the regulators are waiting for Congress, and Congress is kind of going through its process slowly and waiting to see what the regulators think as well in terms of what makes sense in terms of sort of the mechanism for regulation. I think on stablecoins, the substance of the regulation is actually pretty agreed upon, but the mechanism is challenging. I am hopeful, as Matt said, that both in Congress and among the banking regulators and Treasury, there is this recognition that a full insured depository institution charter isn't the right way to go for stablecoins, and there are lots of reasons why that is. But I think that's a really important and good step in thinking about right-sized regulation for stablecoins, which there absolutely should be. It's crazy to not.
Right, and there seems to be this sort of ongoing. I don't want to call it a tete-a-tete, but I feel like in every congressional hearing I see about stablecoins, there seems to be this concern where Congress says, well, if we fail to act, is FSOC going to act? Is this enough of a risk that you're going to do something? Is that a concern in the industry right now? And what's your take on that? Do we need Congress to act? Is there any sort of risk either way? And what's sort of at stake?
That's a great question. I can jump in unless others want to weigh in as well. But look, I mean, FSOC designation could be done in a couple ways. One is as an activity. All stablecoin issuance is a systemic activity and needs to be subject to prudential regulation. Another way is designating stablecoin issuers as systemically important financial market utilities under a separate provision of Dodd-Frank, which would regulate those activities more as payment system activities, not necessarily as just financial activities that are systemic. To be honest, that process will take time, right? There has never been a financial activity designation before. To me, it's not really clear how or why you would designate stablecoin activities. We're clocking at what, like less than $200 billion of market cap. Like there are many, many other financial activities. Think about repo markets, for example, that are much larger and not designated as systemic. I think that would be a very interesting conversation for FSOC to take on. But maybe, I just don't know that that's any faster than Congress or any faster than regulators just trying to do something.
I was just going to jump in and say that, yeah, I think stable coins is an integral part of the ecosystem of digital assets. And so I think it's important that more clarity comes with respect to stable coins. The way we look at this, the way I approach this is that this is putting aside the stable coins, there is this new, emerging new asset class. These digital assets, whether you want to call them digital asset securities funds, it is an emerging new asset class. And the three pillars to break it down, similar to what Matt said earlier, is, you've got the regulation on the trading platform. How is this trading platform going to be regulating? Who is going to be regulating this particular trading platform? And to go off what Ryne said, what is this trading platform trading makes the difference about who is going to be regulating this trading platform. You also have custody. How are these all going to be custodied? Interestingly, I think this is a novel and evolving dynamic part here where custody the underlying technology of the private keys is handled the same, whether something's a commodity or something's labeled as security. So I do think that custody is where the regulators can look to join forces and come up with a path that makes sense across the market, given that the underlying technology is the same. It really, in my mind, wouldn't behoove investors to have a different technology for private keys for this particular label and private keys for this particular token. It should be a standard that is applied consistently throughout based on the underlying technology, because at the end of the day, the custodian is safeguarding and keeping those assets, and we want to make sure that those safeguarding rules apply across the board for all investors. And then lastly, you have the token issuers and disclosures that are required. So the trading platform, the custody, and the token issuers and disclosures that are required. And I think once all three are figured out and there's more regular clarity, then I think everybody will be better off in the system. And I don't think it can be done piecemeal. I don't think that we could be looking at each of these individually. I think that they interwork with each other, and ultimately all three has to be released together. And then ultimately you'll have a system that will function properly, bring in investor protections, and then institutional investors will be able to join.
Yeah. One thing to add, just, we had the Terra Luna collapse in the backdrop of a really potentially pivotal moment for crypto regulation. Obviously, concerns about Russia sanctions, AML, and also we're still in the echo of the White House's executive order, where the interagency at this moment are drafting a multitude of reports, the first batch of which are due in September. So this is really the moment to show that the industry is proactive, to take the right steps, to inform regulators and policymakers, because once those words are on paper, they tend to be a bit sticky, and you have a higher chance of them being codified into law or regulation or forward guidance. So one thing that we're doing in Eventus is just informing governments about the tech and the capabilities with the belief that if governments know what is possible, what tools exist, they are less likely to have blunt instruments, blunt rules and laws, and that just empowers entrepreneurs just a bit more.
Yeah, Mike, good point. And to follow up on that, just in a broader sense, the biggest sort of gating issue that you have when you're talking to regulators and legislators is the educational piece. Frequently there's to be fair, it's not their day job to learn this very complex technology. And so the person on the street, and you can liken the person on the street to, your average staffer on the Hill or somebody that's not really involved in this space. It's very difficult to get them to understand exactly what you're trying to communicate with respect to, what you think is the solution, as opposed to, trying to, take a howitzer out and essentially blow up something that is, perhaps not a particularly acute risk. Number one, you've got a very, very nascent market. It's still very small when you look at the size of the other more established markets. Number two, the risks that are being portrayed are blown entirely out of proportion, in my opinion. So, what needs to be conveyed by this industry, and I'm not sure that we're doing a good enough job, nor I don't think we have a lot of time to do it, is to educate people as to, what these products are, what the protocols are designed to do, and then try and illustrate how or what are the particular risks of these protocols, and then how are they best addressed. And that's a pretty tall task to take on in the limited time frame that we seem to have now. But going back to the time frame, what time frame do we have? Well, we're in the U.S. we're in a particular situation or environment where you're really not going to see much coming out of Congress in 2022. We're leading up to an election. That election will then determine the makeup of who's in the majority in the two houses and so forth. So you're really not going to see legislation moving this year. Potentially we have something next year. So what happens in the vacuum that is created by that? You have regulatory agencies who are acting on their own. And so what you're going to see is continued enforcement, regulation by enforcement. What you're going to continue to see is a lot of uncertainty. You're going to see that there isn't much guidance or openness to approaching regulators with respect to questions that are very sensitive. I saw one comment in the chat is that almost every digital DeFi asset fails the Howey test. I'm not sure you'd want to go that far, but the Howey test itself is incredibly complex when you apply it to this digital asset space. It's not clear, it's not black and white, but we're not getting the guidance either. So, I think that, if you come away from this thing with anything, it's that A lot is not clear, and B, not much guidance coming for a while.
And I just want to harp on DeFi quickly with our final 5 minutes. I know that could be an entirely separate webinar, but in our final 5 minutes, obviously we've been talking more about centralized entities and what, people, compliance teams, what centralized entities can build out to make sure that they are complying with regulations and protecting consumers. In DeFi, that might work a little bit differently. Zaid, can you speak to what you're seeing right now in the landscape there and how these entities are trying to comply and trying to create consumer protection?
Yeah, it's a great question. I mean, to me, an observation that's worth making, I think, is that, up until, in my own view, DeFi, we weren't really seeing disintermediation, right? Driven by crypto. The intermediation was different. And yes, people could use unhosted wallets to hold their crypto, but fundamentally, much of the trading activity was happening on centralized exchanges. Consumers, normal people, and institutions are using centralized or legal entity custodians to hold their crypto for them for lots of important reasons. And I think in DeFi, you start to see the beginnings of actual disintermediation of financial activities, which is something new and something that is quite difficult for regulators and policymakers to deal with. I think it is actually something that is a step change. That being said, I also think that users of crypto, whether it's for investment purposes, for payments purposes, for, to create NFTs, like all of the various use cases, will need some intermediation. I think a fully disintermediated world is unlikely because it's just too hard. Like, it is not convenient and it is too hard. And in my view, the regulators and policymakers would be better served by focusing on right-sized regulation for the intermediaries that exist, which will capture the at-scale activities and protect most of the consumers in the world, rather than tying themselves up in knots on how, automated market maker protocols might work. Like, that is not a good use of regulator time in my own view.
Great. Well, thanks so much for that. And thanks so much for being here, everybody. Thanks so much to our sponsor, Eventus. I've had a lot of fun. I definitely have some things to chew on in my reporting now. And I hope you'll all continue to reach out to me if you see anything in the space that you think is worth talking about. And I look forward to speaking to everybody in the future.
Thank you.
Thanks so much.
Thank you. Thank you all.